So oil is a great asset to trade because you've got a really clear sort of spectrum of price. What is a high price? What is a low price? And you can see that over time fairly consistently. There's a lot of bodies like OPEC and a lot of global economies who want to see oil prices stable. So that makes things even more easier again. So keeping sizes right and using a really concrete hedging method can be very beneficial, of which I'll show you now in this video. Okay, so let's jump into some oil hedging scenarios. This is a method we've used for a very long time, and we're very consistent on oil. It's one of our favorite assets at the Trading Mentor. It's very easy to predict. Prices normally are quite stable. I mean, sometimes you have erratic pulls to the north side, to the south side, but overall, it's fairly stable as an asset to trade, and particularly with organizations or bodies like OPEC, who want to keep the price reasonably sustained, as does various countries whose interest is completely in oil. It's in most countries' interest to just keep things stable because it's beneficial for everyone. Obviously, if oil prices are too high, too low, there's always going to be issues, perhaps regarding imports, exports, or just the general standard of living in that economy. So we're going to run into this max size 0.3 I'm going to go for, and min size 0.1. So on a push like this, you can see the scenario we find ourselves in comes off the back of quite a decent fall. So I'm not really wanting to add anything long, but I would certainly consider something short. So at this point, I'm going to go for a 0.3. I think that's the most sensible size given the way the market looks. So initially on that fall, I can already take sort of $600 gains. The value is configured on the symbol properties, as is the leverage and everything with this. So if it differs slightly to your broker, it's not a big deal. You just need to work out what size you would go for, and also based on the amount of assets you've got in your portfolio. A lot of people ask me, well, it's been X amount of time and you've only made this much. Yes, that's because I'm taking more or less trades. I'm trading one asset. The sizes are different. There's all sorts of factors. The general idea of these videos is just to get you to understand that it's absolutely not the case that you desperately need a stop loss at all times. Otherwise, you can't trade. It's just not true. We've taught this method for sort of 13, 14 years, and it's had great results, as it has for us. So I'm going to add a 0.2 there. It's going to be the remainder of my position. That long is now in gains, and it's very forceful to the upside. So I want to be careful if I add a short. I can see there's resistance all up here, so I'm going to add a 0.2. Okay, and we're now losing money on that short, which is going to give us the opportunity likely to hedge. Okay, so as an example, I could add a half size, or even less than that, probably a quarter size, sixth of max size long, just in case we don't fall. Now we did fall, so I can exit for $60. Then we rose, so I can just kill that. It's negligible. And now the market looks slightly soft, so I'm going to take a short, and that comes off the back of a $13, $14 rally. So I would expect perhaps a decent pullback, and you get it there. I can then add maybe a light long, just in case you pop. Okay, and you did initially, and then again, but now you're falling. So we're coming to, I don't know if my order's still in play there. I think it's gone. I did put a buy order. No, there it is. So if price gets there, we'll be filled long, which is going to be good. And we're not quite filled long. So what I like to do is actually just add myself in case you don't get it by a centimeter, which is what probably would have happened there. And that is really annoying. You can ask any of our members. Close that for $192. And I'll just add a short because it looks like the market trajectory could turn a bit, but I know the price of oil in this instance is fairly low just on the historic basis anyway, especially if you zoom out. So my shorts are really not going to be aggressive or heavy, and ideally I'm going to space them out because they could pick up drawdown. So I'm going to take another one there at 0.15, and then if it didn't rally, but eventually what's going to happen, or at least now, I can essentially just take a hedge. So I've got 0.15 in play there. I can hedge 1/3 of that long, okay, so that if we do pop, then I'll be in gains. Now, we didn't pop, and we're now falling a bit more, then we're popping again. So ultimately, either my long is going to be in gains, or my short will eventually get near a net nothing, or at least into gains, and then I can add again. So I'm going to add 0.15. Remember, when you watch this the whole way through, the idea is to exit for net gains and stay under 10% drawdown, ideally. That is the overall goal. So a little pullback there, I can get long in case we keep rallying, which we did. The gains are only $100, which is 1/15 of the overall drawdown. But you only have to do that sort of 15 times to claim back, the overall loss. And I'm being quite risk averse here as well. I could add another 0.2 perhaps because we pushed even more. Okay, and then I can continue to hedge. So if this keeps going out the money, again, I could take maybe something very light here, maybe 0.08. Okay, slightly heavier than a 0.5. But a nice fall there has delivered gains, and I'm out of that short. So I'm still in net positive. Okay, I can add another 0.08 in case we rally again, which we did a little bit. $82 out for gains there. Now I can recount what we got short and long. Okay, so my overall net position is about 0.22. That previous short is down there. So I could add something again. Could add maybe a 0.12. And I'm really scaling the sizes based on the drawdown, the equity, and where the portfolio stands as such. So I'll take a long in there and I'll pause. See, I missed that long side because I slipped the button. Tried to pause it. You've got to be careful. There we go. So I've got gains on that hedge, gains on that hedge. Now, even though I'm losing money on those shorts, I'm still gaining as the market goes against me, which is the whole point of what we're trying to do here. It's to spread out positions enough so we can cover the whole spectrum of the market. And even though you can see these shorts are slowly coming out of the money, we'll still be in gains overall at the end of what we call the cycle. So that's when all moves are done and the best point really to clear out everything you've taken. So at this point, I'd be looking to hedge long on a decent fall, which we haven't got yet, and I will hedge a more decent size overall. So still rallying a bit further away. Okay, I keep missing the button. I will leave that because I don't want to close a loss. I'll close I'll put 0.08 long in. Now I can close it out. So at this point, I've got 0.38 exposure and I've hedged 0.08 of that. So almost a fifth, okay, or a bit more than a fifth overall. And a further drop is going to allow me to hedge again. So now I'm almost half hedged. I can exit for $80. I could actually add another short. All right. And depending on where we are, I could add again. So that hedge is now in profit. We've got a fairly decent exposure. Nothing major again, keeping the drawdown nice and low, but I can add another 0.08. And on a push lower, I can exit like that. Boom. Close that, add a hedge. And I can add another one. I can also kill that short. And I'll just get rid of those two to simplify things and just recount where I am. So 0.08 taken there, 0.15, 0.15. This one well out the money, but we'll look to close it at a decent rate. So we're in net gains overall. So any real push to the south side, I can kill that one off. I can flip long. Okay, and any push up again, I can kill that off. And I'm going to put the size up slightly. And I'm going to reshort if we get the chance. I didn't, so I'm going to add another long, close that short out. And now you can see the P&L is coming up. So now really I've got the choice. On any big fall, I could exit everything and just be completely out for net gains. So there's another couple of hedge longs, boom, there, out. Add a short perhaps, see where we get. Okay, nice fall. Take that for gains. Take a long there again. Any push, I can close it, another $100, take another short, and so on and so forth. The markets that we pick normally to trade are such that, they're going to give us the best range of opportunities to get in and out. And you can see as the market's moving up or down or sideways, doesn't matter. Because I'm always hedging, I'm picking up more and more gains to protect myself based on where we are. Now, at this point, so if I just close that and I close that, you can see overall net gains, just like every video I film.